Hi, Todd VanDenburg here with VanDenburg Capital Management and another uncommon sense update. So if you'd have asked me a couple of days ago what I'd be talking about today, I would have said turmoil in the Middle East and oil prices rising because of what appears to have been an attack from Iran on Saudi Arabian oil production facilities, because that drove oil prices up substantially, up to about $62 a barrel. Well, the Saudis just came out today and said, yes, some of our facilities were damaged, but we think we'll be back up to 100% production by the end of September. So oil prices have fallen again, and so that's not what I'm talking about today. What I will talk about today is the fact that Chairman Powell of the Federal Reserve came out and said that the Fed is going to lower its target interest rate from 2 to 2.25% down to 1.75 to 2. And as people who have seen my videos before know, I don't understand why the Fed is lowering interest rates at all, because I've not talked to a single person, business owner, or individual who said to me that there's something that they would be doing if interest rates were just lower. Interest rates are near historic lows as it is, so there's almost nobody who's not doing something because interest rates are too high. But yet the Fed thinks that it's going to speed up the economy some by lowering interest rates. It doesn't make any sense, and there are other things actually going on, I think, that are contributing to why they're doing what they're doing. But in spite of what the chairman of the Fed said, the markets sort of had a mind of their own. And what happened overnight is that instead of the Fed funds rate staying within the target as set by the Fed, it spiked up to 2.3%. And so the Federal Reserve had to go in through what they call open market operations, which is sort of a euphemism for printing money out of thin air and buying some things out of the market so that they could inject cash into the market and bring those rates down to within the target. Now, some would argue that this lack of liquidity in the markets is a bad sign for the economy, but I just don't see it that way. And what I see instead is that the government, through some regulations that they implemented back during the financial crisis, has made it a lot harder for institutions to lend. So they're having to keep a lot of their assets in really highly liquid things, not in excess reserves at the Fed, but just in really highly liquid things, because according to the stress test as set out by the government, if a bank can't pass a stress test, then they have to basically change the liquidity of what they own and sell out of stocks or bonds or other things and get back into what they consider more highly liquid assets, government bonds, or maybe cash. So long story short is, in spite of the Fed setting its Fed funds rate where it thinks it should be, the market had a different mindset, primarily because the markets do lack a little liquidity, but not as you would think. There's plenty of money in the economy. It's just that the government has restricted how that money can be used, and so it's really a lack of liquidity that's the problem. There's still $1.4 trillion of money just sitting idle at the Fed in what are known as excess reserves. So there is no shortage of money in the economy. If there were, there wouldn't be so much excess reserves at the Fed. Now, there is one other thing that the Fed did do in their announcement today, and they said that they were lowering the interest rate that they pay banks to keep extra money at the Fed by 0.3% down to 1.8%. And that should just shock everybody that the Fed is actually paying banks 1.8% to keep money out of the economy. Because I don't know about you, but most of the banks I know of, they barely pay 0.1, 0.2, 0.3. You can find higher rates, no doubt, but most people's banks, the major banks in the United States, are not paying anywhere near 1.8%. So in effect, the Fed is paying banks a much higher rate to just park money there then the banks would pay you to park money with them. It's just an odd scenario. So I'm not going to go into too much more detail there, but the long and short of it is the Fed lowered its rates for no darn good reason. Those actions are likely not going to cause any increased activity in the economy, but they're not going to have the opposite effect either. They're not going to slow the economy down. It's just, in my opinion, going to leave the Fed with fewer, things that it could do should the economy actually start experiencing any troubles. Still not a fan of the bond market right now, so don't be looking for opportunities to try to make money in bond trades. Our monetary system is highly volatile right now. You need to be patient, stay with your discipline, keep your cash reserves, and just be patient in what is a fairly volatile market, but a really strong economy. If anybody has any questions about this or anything else regarding their portfolios, please feel free to contact us. We're happy to help. But that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back next week with another Uncommon Sense update. Thanks for watching. If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.